In February 1637, a single tulip bulb in Amsterdam sold for more than a skilled craftsman earned in 10 years. Not a diamond, not a house, a flower bulb, something you plant in the ground and forget about for months. At the peak of the frenzy, one rare bulb called Semper Augustus reportedly changed hands for the price of a canal house in the most expensive city in Europe. Then, within weeks, the entire market collapsed to almost nothing. Fortunes vanished overnight. And for nearly 400 years, Tulip Mania has been held up as history's ultimate cautionary tale about financial bubbles, proof that human greed can turn something as ordinary as a flower into an instrument of mass delusion. But here's what most retellings get wrong. The real story is stranger, smaller, and more interesting than the legend. Tulips arrived in Europe from the Ottoman Empire in the mid-16th century, and the Dutch fell in love with them almost immediately. But it wasn't the common tulip that captured Amsterdam's imagination. It was a rare and unpredictable variety, bulbs infected with a mosaic virus that caused spectacular flame-like streaks of color across the petals. Nobody in the 17th century understood the virus was the cause. To them, these broken tulips seemed almost magical. No two identical, each one a unique work of natural art. And because the virus made bulbs weaker and slower to multiply, the most beautiful varieties were also the rarest. Scarcity plus beauty plus fashion is a combination that has driven speculative bubbles throughout history, and in Golden Age Holland, it found its perfect vehicle in a flower. Tulip bulbs only bloom for about a week each spring, and can only be safely dug up and traded during a few months in summer. That created a problem for a fast-growing market. How do you trade something for most of the year when the physical bulb is in the ground? The Dutch answer was ingenious. They developed contracts to buy bulbs at a future date for a fixed price, regardless of what happened between now and then. This was, in effect, one of history's earliest futures markets, the same financial mechanism that today lets farmers lock in wheat prices and airlines hedge fuel costs. The problem was that these contracts began trading in taverns, among ordinary tradespeople, with none of the regulation, margin requirements, or oversight that make futures markets function safely today. By late 1636, ordinary Dutch citizens, weavers, bakers, chimney sweeps, were trading tulip futures contracts alongside wealthy merchants. Prices climbed, not because anyone believed the bulbs were worth that much to actually plant, but because everyone believed someone else would pay even more for the contract tomorrow. This is the psychological engine of every speculative bubble in history, not irrational belief in an asset's fundamental value, but rational belief that a greater fool will buy it from you at a higher price. Economists call this the greater fool theory, and Tulip Mania is often cited as its earliest documented example. Contracts for a single bulb changed hands multiple times in a single day. Paper wealth exploded, and almost nobody involved had ever actually seen most of the bulbs they were trading. By early February 1637, prices for the rarest bulbs had reached genuinely absurd levels. A contract for a Semper Augustus bulb reportedly sold for 6,000 guilders, at a time when a skilled craftsman earned perhaps 300 guilders a year. That single flower bulb was priced at roughly 20 years of an ordinary worker's wages. One often repeated story tells of a sailor who mistook a valuable tulip bulb for an onion and ate it with his herring, unknowingly consuming a fortune in a single bite. Whether that particular story is entirely accurate or embellished by later writers, it captures something true about the era. An entire economy had become detached from any sensible relationship between price and the actual thing being priced. Then, on February 5th, 1637, at a routine bulb auction in Haarlem, something unusual happened. Nobody showed up to bid. For the first time, sellers couldn't find buyers at the prices contracts demanded. Word spread fast through Amsterdam's tightly connected trading community. If buyers had vanished in Haarlem, they might vanish everywhere. Panic set in almost immediately. Within days, tulip contract prices collapsed by up to 99%. People who had agreed to buy bulbs at peak prices were now legally obligated to pay far more than the bulbs were newly worth, and many simply couldn't or wouldn't pay. The speed of the collapse was breathtaking. A market that took roughly 3 years to inflate lost almost all its value in barely a week. What happened next reveals something important that most versions of this story skip entirely. Because these contracts had been traded informally, often verbally, in taverns rather than formal exchanges, there was no clear legal mechanism for enforcing them once prices collapsed. Dutch courts largely refused to enforce tulip futures contracts, treating them more like gambling debts than legitimate commercial obligations. In 1638, local authorities in Holland ruled that contract holders could settle their disputes by paying just a small percentage of the agreed price, often around 3.5%, rather than the full amount. This detail matters enormously because it means Tulip Mania, whatever damage it caused, did not trigger the widespread bankruptcies, unemployment, and economic depression that later, larger bubbles would cause. Here's where modern historians push back hard against the popular legend. Economic historians who have examined surviving Dutch trading records argue the scale of Tulip Mania was significantly smaller and more contained than the popular story suggests. The trading was concentrated among a relatively small number of wealthy merchants and specialist growers, not the entire Dutch population, as folklore claims. Many of the wildest anecdotes, ruined nobility, mass bankruptcy, economic collapse, come from moralizing pamphlets written decades after the fact by writers with a political or religious agenda against speculation and luxury. The Dutch Golden Age economy, remarkably, continued largely unaffected. There's little evidence Tulip Mania caused any lasting damage to the broader Dutch economy, which remained the wealthiest and most commercially sophisticated in the world for decades afterward. So why has Tulip Mania become the go-to metaphor for every financial bubble since .com stocks, cryptocurrency, meme stocks, housing markets? Partly because it's a genuinely irresistible story. A flower bulb worth more than a house is a detail nobody forgets. But there's a deeper reason. Every generation that lives through a speculative bubble wants historical proof that this pattern of human behavior is ancient, recurring, and ultimately always ends the same way. Tulip Mania offers a clean, simple, morally satisfying narrative. Pride comes before a fall, even when the historical reality was messier and less dramatic than the legend suggests. The exaggeration itself has become part of financial culture, repeated by economists, journalists, and now YouTube videos, precisely because the moral of the story feels more important than its accuracy. The real lesson of Tulip Mania isn't really about tulips, or even about the specific numbers involved. It's about what happens when a new, unregulated financial instrument, in this case, informal futures contracts, meets widespread public enthusiasm and a scarce fashionable asset. That combination has repeated throughout history with remarkable consistency. The South Sea Bubble in 1720, the railway mania of the 1840s, the dot-com bubble of the late 1990s, the 2008 housing crisis, and cryptocurrency speculation in the 2020s. In each case, a genuinely useful financial innovation, futures contracts, joint stock companies, railways, the internet, blockchain, became temporarily detached from realistic pricing because enthusiasm outran regulation and understanding. Tulip Mania isn't unique because it happened. It's notable because it happened first, and we have unusually good records of exactly how it unfolded. When you look at a meme stock surging 500% in a week on social media enthusiasm rather than earnings, or a cryptocurrency token worth billions with no clear underlying use case, you are watching a version of the same psychological and structural pattern that unfolded in Amsterdam's taverns in the winter of 1636. The technology changes. The specific asset changes: bulbs, railway shares, .com stocks, digital tokens. But the underlying mechanism stays remarkably consistent. An unregulated or newly created market, a compelling story about future value, social proof from other people getting rich, and the quiet assumption that someone else will always be there to buy at a higher price. Understanding Tulip Mania accurately, not the exaggerated legend, but the real, more contained event, actually makes it a more useful lesson, not a less interesting one. A flower that bloomed for 1 week a year became, for a few short months in the winter of 1636, the most valuable commodity in one of the wealthiest cities on earth. Then it became almost worthless again, just as quickly. The legend grew larger than the event itself, which might be the most fitting outcome possible for a story about the gap between perceived value and real value. If you enjoy history that quietly explains the financial world we still live in today, subscribe. There's a lot more of this coming. Next week, we're traveling to medieval Florence, where a wool merchant family called the Medici built the most powerful bank in Europe, financed the Renaissance, and eventually lost it all. I'll see you there.